कर दो। Good morning friends, how are you? I hope you are doing good. Today we'll take one more topic in advanced capital budgeting, and that is called adjusted present value, or in short we will write APV. This is another approach towards calculating net present value. Under this approach, investment decision and financing decisions are kept separate. Investment and financing decisions are kept separate. What does that mean? So here NPV will be first calculated as if it is fully financed by equity, as if it is fully financed by equity. First you calculate NPV as if it is fully financed by equity. That means you are going to use cash flow divided by, or NPV based on cash flow available to equity shareholder. You will use cost of equity as a discount rate. You will use cost of equity as a discount rate. Forget for some time that there is any debt. Forget for some minutes that there is any debt. Had it only been financed out of equity instrument, equity share, what would have been the NPV? And for cost of equity, if required, use the CAPM formula, RF plus beta into RM minus RF, RF plus beta into RM minus RF, and beta will be unlevered beta. Beta will be unlevered beta. What is unlevered beta? Refer portfolio chapter. Refer portfolio chapter. Unlevered beta is the beta of equity of a firm which uses only equity, which doesn't use debt. So it is beta of a 100% equity finance company. It is beta of an unlevered firm, right? More detailed discussion was done in our chapter portfolio management. So right now we will not enter into that area, and not required also. So this is how you will compute first NPV, assuming it is fully funded by equity. But if you are using debt also, then debt has an advantage. What is the advantage of debt? You have tax shield on interest on debt. If you are using debt, then use of debt has an advantage. You will be paying interest on that, and on that interest, under the income tax law, you get the tax shield. So adjusted NPV will be NPV as if it is only financed by equity, that is the investment decision, plus if you are using debt on which you get tax shield, then you will take present value. This will be present value of tax shield on interest on debt. And in case if you have incurred some flotation expense or issue expense, that we are going to adjust. This is NPV method. And just to remind you, we have done in detail one question in International Capital Budgeting chapter. That question was also under APV method, International Capital Budgeting. In our syllabus we have covered, and that was also done under APV method. So more detail I have written there, so I don't want to repeat it again, but still whatever is required I have explained. first compute the value of the firm as if it is an equity finance company, add present value of tax shield on debt, that is adjusted present value method. So how do I compute the NPV? First you compute base case NPV. This is base case NPV. What is base case NPV? Assuming that the project is fully financed out of equity, no use of debt, only for assumption. But if you are using debt, then the PV of tax interest on debt, tax saving on debt will be considered, minus any issue expenses, if any, will be deducted. Base case NPV is calculated using cost of equity, assuming that the company is a levered firm. Unlevered firm means no use of debt. Treat it for some second as if it is an all equity finance company, and since the viability of the project is partly dependent on how the project is financed, the PV of tax benefit on interest payment is also considered. So investment and financing decision are considered separately. First you evaluate it without considering the role of financing, then you bring the benefit of financing. Thus this method provides a broader view to evaluate a project considering the benefit of increased use of debt in financing of any project. In our intermediate syllabus, do you remember there was a chapter called Modigliani and Miller approach? What is Modigliani and Miller approach? Under that there were two theories. One is no tax theory and with tax theory. I am doubtful how many of you will remember, but if there is no taxation, value of two firms are equal. If there are no taxation, value of two firms are equal. Modigliani and Miller theory. But if there is a taxation, value of a levered firm is equal to value of unlevered firm plus PV of tax shield on interest. Using the same logic, we are now going to compute adjusted present value also. First compute firm is an equity finance company. Add the PV of tax shield on interest. Deduct any issue expenses. This method evaluates by separating investment decision from financing decision. So we'll solve a question number 93 from May 18 exam. Question number 93 from May 18 exam. This question is not in your study material. For your information, your study material does not have any question on APV method, but in the exam they ask you. In the exam they will ask you. So I hope you are ready. Question number 93, please write, very important for exam. Please write, very important for exam. XYZ is presently all equity financed. The directors of the company have been evaluating investment in a project which will require rupees 270 lakhs capital expenditure on the new machinery. Presently all equity financed. Presently all equity financed. And what is the funds required for this project? 270 lakhs. They expect that the capital investment to provide annual cash flow of rupees 42 lakh indefinitely. That means this project will generate 42 lakhs per annum perpetually. Perpetually means forever. Forever. So this becomes a perpetuity. You have to apply the formula of perpetuity. you will have to apply the formula of perpetuity, which is net of all tax adjustments. That means it is after considering income tax paid also, but right now it is an equity finance company. This 42 lakh does not have any impact of debt financing. It is purely your operating cash flow after tax. It is purely operating cash flow after tax. The discount rate at which such investment decision is 14% net. What is your discount rate? 14%. So PV of cash inflow will be 42 divided by 14%, A upon R formula, annuity upon rate of discount, annuity upon rate of discount, annuity upon rate of discount, 42 upon 14%, 42 divided by 14%, answer please, 42 divided by, so PV of cash flow, present value of cash flow will be 300. The directors of the company believe that the current capital expenditure fails to take advantage of tax benefit of debt and proposes to finance the new project with undated perpetual debt secured on the company's asset. Now they want to finance this project using debt. They want to finance this project using debt because they are not getting the benefit of tax shield on interest. So they want to issue debt, perpetual debt. What is perpetual debt? It will have no maturity. So only you are going to pay coupon every year. The company intends to use sufficient debt to cover the cost of capital expenditure and the after tax cost of issue. Amount of debt to be issued is equal to amount of debt to be issued is equal to cost of capital expenditure plus after tax cost of issue, because if you issue exactly 270 lakh and you have to also incur the issue expense, then you will not be able to fully finance the project. Next point, the current annual gross rate of interest required by the market on corporate undated debt of similar risk is 10%. So interest rate is 10%. The after tax cost of issue are expected to be 10 lakh. And to issue debenture, your cost of issue would be 10 lakh. So how much would be your amount of debt? Anybody who wants to guess, amount of debt will be how much? 270 lakh you require for capital expenditure. 10 lakh rupees is your after tax cost of issue. So total debenture to be issued would be 280 lakhs. Total debenture to be issued will be 280 lakhs. And what will be the tax shield on that? What will be tax shield on interest? Tax shield on interest will be 280 lakhs into 10% interest into 30% tax rate. Tax shield on interest on debt, 280 lakh you have to raise so that you can meet capital expenditure and issue expense, into 10% interest amount into 30% is the tax shield for 1 year. That comes to 8.4 lakh. 8.4 lakh is your annual tax shield, and the tax shield will continue forever. Tax shield will continue forever. So present value of tax shield will be, present value of tax shield will be how much? Present value of tax shield will be, if you are going to receive 8.40 per annum forever, the present value of tax shield will be calculated using cost of debt as a discount rate. Will be calculated using cost of debt as a discount rate, and therefore this will be 84 lakhs. Now my question is, dear student, what will be the APV? What will be the APV? You are going to get an NPV of 300 lakh here, base NPV 300 lakh, sorry not 300, 300 minus 270 project cost 30 lakh, 30 lakh base NPV plus 84 lakh tax shield, plus 84 lakh tax shield and minus 10 lakh issue expense, 30 lakh base NPV plus 84 lakh tax shield minus 10 lakh issue cost. So anybody, what would be the final adjusted present value? 30 plus 84 minus 10, 30 plus 84 minus 10, 104. So the answer of this question is adjusted PV will be 84 lakh. Adjusted present value will be 84 lakh. First base NPV. If the project is financed 100% by equity, your NPV is 30 lakh, then tax shield on interest 84 lakh minus issue cost 10 lakh, that is the answer. Very easy question but very important question. So please write in the notebook, heading write down calculation of adjusted present value of investment. Calculation of adjusted present value of investment, APV. In short, write APV. Later on, at all places you can write APV. First we'll compute base case NPV. Base case NPV, the project cost is 270 lakh minus 270 lakh plus in bracket 42 lakh divided by 14%. 42 lakh divided by 14%. 42 lakh divided by 14%, that is minus 270 lakh is your initial investment in the project and 300 lakh is your PV of future cash inflow. If the project has infinite life, the present value is A upon R. Present value formula is A upon R. If it is an infinite annuity. Next is step 2, issue cost. Step 2, issue cost. Issue cost is 10 lakh. Issue cost is 10 lakh. Now write down thus the amount to be raised equal to amount of loan to be raised equal to amount of loan to be raised is equal to amount of loan to be raised equal to 10 lakh is issue expense, project cost is 270 lakh, so total funds to be raised by issue of debt is 280 lakh. 280 lakh. Then write down step number 3, annual tax relief on interest payment. Annual tax relief on interest payment. Annual tax relief. Annual means only for 1 year. 280 lakh into 10% into 30%. 280 lakh into 10%, 28 will be annual interest into 30%, interest into tax rate. Interest multiplied by tax rate is called tax shield. So 8.4 lakh perpetuity, in perpetuity. Step number 4, present value of tax relief in perpetuity. Present value of tax relief in perpetuity. 8.4 lakh divided by 10%, 8.4 lakhs divided by 10%, 84 lakh. 8.4 lakhs divided by 10%, 84 lakh. Now write down step number 5. Step number 5, write down APV. Step number 5, write down APV. always write the formula first in the exam. Base case NPV minus issue cost plus PV of tax relief on debt interest plus PV of tax relief on debt interest, and that is equal to 30 lakh the project will generate without considering the role of financing. Pure investment decision 30 lakh, 10 lakh issue expense, 84 lakh is due to tax saving on interest. So that comes to 104 lakh. That comes to 104 lakh. That comes to 104 lakhs. Now the student can have a query, why we have taken 10% discount rate here. I will dictate a note for this. Write down note. Write down note. I will dictate. For calculating present value of tax shield on interest, for calculating present value of tax shield on interest, for calculating present value of tax shield on interest, we will use rate of interest. We will use rate of interest as discount rate. We will use rate of interest as discount rate. We will use rate of interest as discount rate on the assumption that tax shield on interest are as risky as the interest which generates them. Tax shield on interest are as risky as the interest which generates them. Tax shield on interest are as risky as the interest which generates them. Next line, write down, if we assume tax shield are certain, if we assume tax shield are certain, we can even use risk-free discount rate. We can even use risk-free discount rate. We can even use risk-free discount rate. Now we'll go to one more question, 94 number. Question number 94. Question number 94. From reference book, one more practice on this, and we have also done one question in international capital budgeting. So whatever question you would ask would be mostly around these questions only. First, come to 94. Initial investment is 500 lakh. So the project will require 900 lakh funded by 10% debt, rupees 200 lakh. Interest will be paid every year. So interest will be paid every year means every year 20 will be paid, while loan amount will be repaid at one shot at the end of 5th year, and in the last year principal amount will be repaid. Equity would be 300 lakh. Cost of capital is 14%. Cost of capital is 14%. Operating CFAT means without considering interest. Without considering interest. Operating CFAT is 140 lakh per annum. So it has not considered interest implication. Tax rate is 30%. Flotation cost of equity is 2%. Flotation cost of equity is 2%. You require 200 lakh from debt, 300 lakh from equity. So 300 should be net of flotation cost. 300 should be net of flotation cost. So my question is, what would be the flotation cost? What would be the flotation cost? What would be the flotation cost? 300 divided by 98% into 2%. What would be the flotation cost? Anybody answer? 300 divided by 98%, because I need 300 after incurring expense. So tell me, 300 divided by 98 into 2, how much is that? Nobody is responding. Are you sleeping? $300 divided by 98% into 2%. So 6.12. 6.12 is right. 6.12 is right. Wait. Where are you going? Come back. The problem says evaluate the project by adjusted PV approach. Just make a small change here in the problem. Write down here cost of equity. Cost of equity instead of cost of capital. Write down cost of equity. Solve the problem again by assuming that principal amount of the loan is to be repaid in 5 equal installments at the end of each year. So this is part 2. This is part 1. First part, principal amount will be paid at the end of the 5th year, and in the second part, principal amount, which is 200 lakh, divided by 5, 40 lakhs will be paid every year. 40 lakhs will be paid every year. Okay. So how do I solve it? Write down. First, case 1. I have to solve it twice. 1, principal amount is paid at the end of 5th year. Second, principal amount is paid in 5 installment. So first I am going to compute base case NPV. Base case NPV means NPV as if the project is fully financed out of equity. As if the project is fully financed out of equity. For a minute, close your brain, close your eyes, and just imagine that this project is fully funded by equity. Base case NPV 140 lakh. So it is NPV assuming project is fully funded by equity. Assuming project is fully funded by equity, so you will write 140 lakh is your cash flow after tax, operating cash flow after tax, 140 lakh into PV annuity factor 14% 5 year minus the project cost, minus the project cost. Yes, you have to answer, please. You have to answer. What is the annuity factor for 14% and 5 year? $3.4331 multiplied by 140 minus 500. Anyone who would like to answer base case NPV? Base case NPV is negative 19.38. Very good. Very good answer. Negative 19.38. So if the project is wholly financed by equity, it is not viable. Write a note. Project is not viable if it is 100% financed by equity. Project is not viable if it is 100% financed by equity. But management has not financed it 100% by equity. Management has also borrowed some money. So let us see how by borrowing 200 lakh debt how can it improve the NPV of the project? Because on the borrowed part you'll pay interest. On interest you'll get tax shield. So tax shield will increase your NPV, but let us see whether with tax shield also the project is viable or not. So step number 2, write down tax advantage of debt. Tax advantage of debt. Tax advantage of debt in this problem, the loan will be paid after 5 years. So interest amount will be constant for 5 years. Interest amount will be constant for 5 years. So please write debt into interest rate into tax rate. Debt into interest rate into tax rate. 200 into 10% into 30%. On 200 you pay 10%, that is 20. On 20 you get 30% tax shield, and that is 6. 6 will be per annum. 6 will be per annum, and for 5 years, you are going to save 6 lakh. So write down step number 3, present value of tax advantage of debt. Present value of tax advantage of debt. Present value of tax advantage of debt, and you will take 6 multiplied by PV annuity factor 10%, 5 years. 10%, 5 years. Now tell me how much is 10% 5-year annuity factor. Be little proactive. Don't wait for the instruction. Be ready and answer now. 3.7908 multiply by 6, 22.74. 22.74 is the tax advantage of debt. Is the tax advantage of debt. Now write down step number 4, flotation cost of equity. Flotation cost of equity. Flotation cost of equity will be 300 divided by your flotation cost is 2%. So you have to raise more than 300 because project requirement is 500. So 300 divided by 98% is the amount of funds you need to raise from equity into 2%, 6.12. So 6.12 will be my flotation cost of equity. Now write down step 5, adjusted present value. Step 5, write down adjusted present value. Step 5, write down adjusted present value. Always write formula in the exam for full marks. Base NPV plus PV of tax advantage of debt plus PV of tax advantage of debt minus flotation cost. Minus flotation cost. Base NPV minus 19.37. PV of tax advantage of debt 22.74 minus flotation cost 6.12 minus flotation cost 6.12. So that is minus 2.75. Please check the calculation. Please check the calculation. Is it right? Is the calculation right? Minus 2.75. Note, write down project is not viable. So this project is not viable with this debt financing also. Okay. Can we go to the next part of this question now? The second part of this question is loan will be repaid in 5 equal installments. Loan will be repaid in 5 equal installments Loan will be repaid in 5 equal installments. Same 4 steps will follow. First will compute base case NBV. No need to calculate again. Already calculated 19.37 lakh. 19.37 lakh. Then write down step 2, tax advantage of debt. Tax advantage of debt, write down year, amount outstanding, then write interest at the rate 10%, interest at the rate 10%, interest at the rate 10%, tax shield at the rate 30%, tax shield at the rate 30%, and last column PV of tax shield at 10%, PV of tax shield at 10%, PV of tax shield at 10%. First write down year 1, 2, 3, 4, 5. Year 1, 2, 3, 4, 5. Then write down amount of debt outstanding. First year 200 for interest calculation. Every year 40 will be repaid. Every year 40 will be paid. So next year the outstanding balance is 160, 120, 80, 40. On this amount you will compute the interest 10%. Compute 10% without calculator. Try today. Show to this world that you are very intelligent candidate. You can multiply even without calculator. Very good. You are walking genius on this planet. Now next point, tax shield at the rate 30%. Tax shield at the rate 30%. Tax shield at the rate 30%. 6, 4.8, 3.6, 2.4, 1.2. These are the tax shield you will get in different years. Please convert into present value using 10% discount rate. 6 divided by 1.10 equal to 5.45. 4.8 divided by 1.10, 2 times equal to 3.97. 3.60 divided by 1.10, 3 times equal to 2.7. 2.7. Next 1.64. Next 0.75. Please take the total of the last column. Take the total of the last column. That will give you PV of tax shield, and the answer is 14.51. Very good. Is right. 14.51. Very good. So this is my tax advantage of debt. Now write down step 3, flotation cost. Flotation cost is same, already calculated 6.12 lakh, already calculated. Flotation cost of equity 6.12 lakh. And now the last point, step 4, APV. Come on, you will give me the answer. You will reply. Then I will understand that you are right. Anybody answer APV? Nobody wants to reply. Base NPV plus PV of tax shield minus flotation cost. You are right. 10.98 lakh. Very good. 10.98 lakh negative. So the answer is project is rejected. Project is rejected. The answer is project is rejected because NPV is negative even after considering the tax shield on interest. The project is rejected, right? So this was APV method. One more question I will take from self practice part, question number 95. From the self practice part there is a question number 95. Please turn about 3 to 4 pages. One more question I will take which is of different type. Question number 96, note down homework. Question number 96 homework. 97 I have done. 97 I have done. 98 also we have done. Only one question will remain which you can do as homework. Is it right? So this will complete, to my understanding, all the study material question, all RTP question, MTP questions and all past exam questions on this topic. So everything at one place, arranged chapter wise, topic wise, concept wise. It will be very useful for you at the time of revision. So question number 95, I'll just read from the book because this question is not appearing on the screen. I will read it from the book. Keep the question paper in front of you or the booklet in front of you on capital budgeting. Jumble Consultancy Group has determined relative utilities of cash flows. Relative utility of cash flow. So they have added one concept called utility of cash flow. Our study material does not have any theory on that, but the question paper contains one question. Amazing. Welcome to the institute. It is not in the syllabus, but there is a question. So I will take it briefly because this question had only been asked once in the entire history of the institute. So be ready. If they ask you, it is very easy. So I'll read the problem again. Jumble Consultancy Group has determined relative utilities of cash flows of two forthcoming projects of its client as follows. Cash flow in rupees and their relative utility to the company. So if cash flow is 15,000, its utility value is 100. If it is 10,000 negative, minus 60. If it is 4,000 negative, it is minus 3. If it is 0, 0. For 15,000, positive 40. For 10,000, positive 30. For 5,000, positive 20. For 1,000, positive 10. So this is the general practice of this company. If this is the cash flow, this is the utility value we will assign to it. Now there are two projects. The distribution of the cash flow project A and project B are as given below. Project A cash flow is given. You will substitute the cash flow by the utility. You will substitute the cash flow by the utility. For example, 15,000 negative has a minus 100 utility. For second one is how much? There is some typing mistake. Second one minus 10,000. Second is minus 10,000. Probability is 0.20. Third one is 15,000. Probability 0.4. 10,000, 0.20, 5,000, 0.10. And in case of project B, they have given you cash flows in different possibilities of cash flows and their probabilities. Which project would be selected and why? So first I will give you a small note on this. This method is called expected utility maximization. This method is called expected utility maximization. Write down expected utility maximization. This method advises us to select the project with the highest utility, to select the project with the highest utility, that is highest summation of probability into utility, highest summation of probability into utility, highest summation of probability into utility. Then write down, I hope you have written the note. Have you written the note? Yes. So just put the utility in front of the cash flow, multiply by the probability, the one which will give you highest expected utility, the one which will give you highest expected utility, that project will be selected. So in one table only we can do it. Write down step 1, calculation of expected project utilities, calculation of expected project utilities, calculation of expected project utilities of project A and project B, of project A and project B. So what I'll do, they have given us cash flow. Write down first format, project A, project A. Under project A, we have 4 columns: cash flow, probability, utility, probability into utility, probability into utility. Then project A, cash flow, probability, utility, probability into utility. And now after you have drawn the format, write down, in the project A, cash flows given are 15,000 negative, 10,000 negative, 15,000 positive, 10,000 positive and 5,000. The second number is minus 10,000. If by mistake in your book some other number is printed, you make it minus 10,000. Probability is given in the problem. These 2 columns are from the question only. These 2 columns are question. Now how do I write utility? What is the practice of this company? If cash flow is minus 15,000, the company assigns a utility value of 100 negative. If cash flow is minus 10,000, the company assigns a utility value of minus 60 from the original table in the question book. If cash flow is plus 15,000, 40. If cash flow is 10,000, 30. If cash flow is 5,000, cash flow is 5,000. Yes, how much utility the company will assign to that cash flow? 20. Is it right? Please multiply these 2 columns and take the total. This is your first answer. I want you to reply the answer. Everybody, I'll wait for you. First you multiply probability into utility. Take total. Probability into utility and then take total. Come on student. One student is replying 2. Very good. The answer 2 is right. Amazing. Now you do the project B yourself. Project B. yourself. Project B. Project B you have to do yourself. You have to assign utility value yourself. You have to multiply yourself, total yourself. Those who want to copy will wait. Some of you are only copying. At least one student I know. You should participate. This is an opportunity. Question number project B. What is the answer? What is the answer? Please reply. What is the answer? Anybody answer in the last column? Answer in the last column here, total. What is the total? What is the total, please? What is the total of project B? 17.55 is right. Very good. Everybody got 17.55. So the policy of the company is to select the project which will have highest expected project utility. Answer B, write down. Answer project B. Advice, write down project B should be selected. Project B should be selected as it has highest expected utility. As it has highest expected utility. Project B should be selected as it has highest expected utility. As it has highest expected utility. Project B should be selected as it has highest expected utility. Is it right now, all of you? So this is how this type of problem will be solved. Only once they have asked the same question. Now you come back. We have some theory paragraphs also. Okay. Impact of change in technology on capital budgeting decision. Very easy. You can stretch your imagination and you can write whatever you want to write in the exam. So if they ask you an essay on how changing technology is going to impact the capital budgeting decision, so that is something which your creativity and your imagination will give you marks, not me. Okay, so you will say change in technology is a very qualitative factor. It is not just a quantitative factor, it is a very qualitative factor which can affect future cash flow, and therefore if future cash flows will get affected, capital budgeting will get affected. You will start, suppose, manufacturing mobile phone with some technology. Okay, and you are projecting your cash flow for next 6 years, but see, it is possible that the phone that you are manufacturing is based on a certain technology. Will you be able to provide the same product with the same technology over 6 years? No, maybe after 2 years better technology is available in the market now. Okay, and therefore the demand for your product may go down. So change in technology can affect your business. You are a software company. You are providing certain software to the clients. Again here technology can change and your software can become little outdated now, and the client will demand high quality software, better software, and he says, sorry boss, this is not going to work for our company, right? Nowadays businesses are getting seriously affected by changes in technology. Change in technology can completely change the way the businesses were being done. Take the example of education only. One of the greatest revolution which has happened in the last few years is in the field of education. The offline education has shifted to online education. Like what you are doing right now is online education. Earlier we used to come to the class, okay, physically. We need to create infrastructure for the student. We need to employ more manpower, okay, to do the administrative work. Suppose hundreds of crores of rupees were invested in the infrastructure for offline classes, college campus, classrooms, okay, so many infrastructure required in the school. All that has gone. All those colleges, most of the colleges can be fully shifted into online business model. You don't need to physically go to college. Unless some practical is to be done in laboratory, you're not really required to go to colleges. Like what is happening in our current education, you are not really required to come to our classroom, okay. So this capital budgeting means all the infra that you had invested here, you will not be able to recover their cost. Technology can impact the budgeting, or it is happening in automobile sector nowadays. Companies had invested huge capital on petrol vehicle, diesel vehicle. Thousands of crores of rupees were invested in that kind of technology, but suddenly EV has come and all your current business model will get affected, and therefore whatever cash flow projections you might have done may not sustain. This way capital budgeting can be seriously affected by changes in technology. So the question is, why it is important to analyze the impact of change in technology? The answer is that change in technology can affect the production process because of use of artificial intelligence, use of robotics. Now the production process can be reduced in if suppose it was taking 10 days, it might be reduced to 1 day only. Use of technology can improve the quality, it will increase the accuracy, precision, okay, it will increase the delivery time faster, it will make more flexibility. From delivery time, I remember nowadays there are companies which say that if you order something, we will deliver within 30 minutes. How does it happen? It happens because of the change, because of the technology. There is a whole back-end technology on which it is working. The moment you place the order, there nearby what they call dark warehouse, there all these things are assembled in a certain logical manner, and then there are robotic arms. They will start assembling the product and bring it near the counter. One delivery boy, he immediately gets a message. The one who is nearest to that warehouse, or those who are already stationed there, they will just pick it and deliver it to the customer's place. And that is because of technology. And because of this, see what is happening to the physical stores now. Those who have invested huge amount of money in physical store, they will find that their expected cash flow has got reduced because more and more people will be using mobile app technology to purchase goods. They will not come to the physical stores only. That is the impact of technology in capital budgeting. Your whole expected cash flow planning for last 12 days that we are learning is a waste if the technology changes suddenly and those cash flows cannot be realized. Changed technology can also result in reduction in cost of capital also. Cost of capital can also reduce. If the profitability increases, cost of capital can reduce. If the company can negotiate lower interest rate, then cost of capital can reduce. Technology changes can also have a positive effect. If you can adopt the new technology, it can bring more cash flow to you. Technological changes will require additional capital expenditure. Every year, do you think this Apple company which sells iPhone, are they selling same model every year? No. Every year or every 2 years they will come out with a new model, which means they are putting more and more expenditure on research and development. So continuous expenditure on capital expenditure will be required. The sales volume can also be changing. In past we used to have a longer cycle of a product, longer life cycle. Now the life cycle of the products will get reduced. For example, mobile phones. Every 1 year, every 2 year, some new model comes. They say you can fold it, you can do so many things on the mobile. Mobile memory size has also gone up to 1 TB also, etc. And because of change in technology, customers' preferences can also change. And therefore, the whole capital budgeting planning will get affected. As a capital budgeting manager, as a planner, you have to also visualize that if my product is linked to technology, how my cash flows can get affected if the technology changes. Will it be affecting my sales positively or negatively? Then the next issue will arise, how to incorporate impact in capital budgeting decision. Change in technology is a risk. Change in technology is a risk, and therefore it should be considered while applying capital budgeting techniques like sensitivity analysis. We will see what happens if sales drops by 20%, because if technology changes, sales may drop by 20%, 40%, and how will your NPV be affected? Or scenario analysis, worst case scenario, if technology changes, my sales will be very low, then what is my NPV? Or simulation analysis, we will try to adjust various variables. Sales will decrease, variable cost will decrease, product life will reduce, how my NPV will be affected. So all these analysis that we have learned, there we have to incorporate the effect of change in technology. Change in technology can have both positive and negative effect. So you have to take into account worst case scenario, which we have learned, best case scenario, etc., and do the evaluation. If technology changes so much that your product becomes completely obsolete, one has to also evaluate abandonment option. One has to also evaluate abandonment option, that what if I have to abandon the project, how much would be my NPV? Discussed earlier. Abandonment project is already discussed, and as you know, higher the risk, higher the discount rate. One way to incorporate the risk of change in technology is to use a higher discount rate. That was about change in technology. Now the next is change in government policies. Can change in government policy impact the capital budgeting decision? Can change in government policy impact the capital budgeting decision? Say yes or no only. Can change in government policy can impact future cash flow that the project was supposed to generate? Is the answer yes or no? The answer is yes. Okay. Change in government policy can not only affect us, it can affect our supplier also, from whom we purchase raw material, input, component. It can affect our buyers also, customer also, service provider also. Recent example of change in government policy is they are focusing more on electric vehicles. Companies have already invested in factories which are designed to produce petrol, diesel based vehicle. So their cash flow will be affected because government is promoting EV for environmental reasons. They are promoting. In fact, they are going to ban this diesel vehicle in some state after some time. They have also brought the scrapping policy. A vehicle which is 15-year-old will have to be scrapped. One more example will be, for example, ban on plastic. Imagine those companies which were manufacturing plastics. What will happen to them? They will have to shut down. Abandonment will apply. Or for example, you are importing. Your supplier is in foreign country. You are an importer. Government increases the duty. Government increases the duty, and because of that, the supplier says, no, sorry, we will not be able to supply because we are no longer competitive in your market now. So that can affect. Or your buyers can be affected. If your buyer is in a foreign country and their government changes the policy not to purchase from India, ban India from, their government brings law that certain products cannot be imported from India. It has happened in the past. US government may bring a law as long as you can get service from a US company or a US citizen. You are not going to outsource it to an Indian company. The Indian service providers will be affected. Okay. Government policy can overnight change your business and can seriously affect you because you don't know what they can do. Of course, change in government policy can have positive effect also. Government will suppose say that we are going to increase the import duty on a product which was a big competitor for you. Is it right? Now that product becomes very expensive if you import. So what will Indian customers do? Indian customer will purchase from Indian company. Is it right? If Indian companies will purchase from Indian companies, the sale of your company can increase. Some recent announcement by the government was that now if you purchase laptop or mobile from abroad, you may or may not have read this news article, you have to take a license from the government. Amazing. You have to take a license to purchase foreign made mobile phone laptop. That means if you want to import. Why this policy was brought in by the government? The government wanted that Indian companies mobile phone, Indian companies laptop should be promoted, and that is why we are making import little difficult. So this is the government policy. Few examples I have given, but it will be beneficial to the local supplier, local manufacturer. What is more important is that impact of such policies should be analyzed. If required, estimation should be revised adequately. So when you are doing capital budgeting programming in year 0, you have to visualize, can the government policy change in future? 1. If yes, how your cash flows will be affected? Will it be positively affected or will it be negatively affected? And suppose the government policy changes here, again you will have to revise the estimate, compare with your abandonment value here and see whether you should continue or abandon the project. If required, the firm should continue to think about abandoning the project. So government policy can impact domestic capital budgeting decision and it can impact international capital budgeting decision. We have already seen international capital budgeting in one other chapter. So to keep the story simple, I have just made a small summary of what is written in the book. Government policy can have a long-term impact because it may change after a long period of time. Once they make the policy, then the policy remains for a long time. It is changed after a very long time, but it will have a long-term impact. Like for example, in your economics in 12th standard, they will teach you new industrial policy, liberalization policy of the government brought by Manmohan Singh and P.V. Narasimha Rao, Prime Minister at that time. And because of this new industrial policy, licensing was abolished in most of the industry. Foreign direct investment was allowed. More competition was allowed. Private sector was given more role. So that was a long-term policy. Certain policies change from quarter to quarter or year to year. For example, fiscal policy means budget. Fiscal policy means budget that is presented every year. In that budget policy, the government announces their spending policy, expenditure, which sector they are going to spend more. So now they are spending more on infrastructure. So companies which are into infrastructure business, their demand will go up because government is purchasing lot of input required for infrastructure, or the government is focusing more on defense segment also in recent budgets. So companies which are into production of defense material, defense equipment, their product demand will go up. Taxation policy of the government can impact the business. If they increase the tax rate, decrease the tax rate, increase the MAT rate, change the dividend rate, all this can affect your cash flow and therefore your future cash flows. Government borrowing, government is a big time borrower, or can I say government is the biggest borrower. Yes, when government borrows, funds available for lending to private sector reduces. This is called crowding out effect. In your economics they teach you, when government starts borrowing, then less surplus is left for private sector. So therefore their capital budgeting will get affected. That is fiscal policy. More about fiscal policy, refer your economics old books if you have kept it. Okay, unless you have sold it, you can refer it. Not required, just you have to mention government expenditure policy, tax policy, borrowing policy can affect capital budgeting decision. Like government have started giving incentive to startup companies. Okay, this was an example. More and more startups are now coming into India. Okay, then you can quote SEZ policies, special economic zone policy, and recently they have given some more incentive. I think that is called PLI scheme, productivity linked scheme. So all these are the policies of the government which is bringing more investment into a sector, but at the same time by changing the direct tax, indirect tax rate, they can affect the business. So some businesses like casinos, horse racing, okay, online gaming, what you do on your mobile before every match starts, make your own team. These businesses are affected because of the increase in the GST rate, and some of them may not be viable only after some time. So that is the fiscal policy. Or some companies had started cryptocurrency trading. Government says all such cryptocurrencies are not acceptable or not recognized by the government of India. So all those platforms have vanished now. That is the impact of government policy, fiscal policy or government policy. Another is monetary policy. Have you heard RBI coming out with quarterly review of the monetary policy? Every quarter, monetary policy committee, they meet and they make some changes in the policy if required. For example, they can increase or decrease the repo rate, the rate at which RBI lends to the bankers. They can increase or decrease CRR, cash reserve ratio. They can increase or decrease SLR, statutory liquidity ratio. They can increase or decrease open market operation, OMO, through which they buy or sell government securities. The purpose of all this monetary policy is to bring price stability, generate employment, generate growth, make credit available, okay, and impact the liquidity in the economy. The problem is, if they increase the repo rate, the interest rate goes up and your cost of capital goes up. Interest rate means cost of capital will get affected. Is it right? If they increase the interest rate sometime, the demand for many products like refrigerator, housing, bikes, car, mobile, which nowadays customer buy on installment, that get affected. So if you are a company like, let's say, HDFC Bank, where people borrow money from you to buy houses, but if the interest rate goes up, they may not borrow, they may postpone the purchase plan, and that can affect your projected cash flows. So monetary policy can directly impact you if you are a borrower, or can impact you if your customer is using borrowed money to purchase certain goods that you manufacture. So this is how government policy can impact domestic market. International market, I have explained, government can enter into double taxation avoidance agreement, DTAA, and because of that, the tax rate or the tax liability of a company can get affected. If there is no DTA, you may have to pay tax on the income generated on foreign country also, and you have to pay tax in India also. So that can affect your net cash flow after tax. But if there is a DTA agreement, then your tax liability is reduced. Another is, if you have heard about change in tax rate relating to foreign income, can affect your cash flow. Then there are transfer pricing rules. You can mention that also in the exam. Transfer pricing rules are there. Irrespective of the price at which you show in the books, the government says for tax purpose we are going to assume this is the price. Transfer pricing rules are there which can affect you. There are withholding tax rules. Withholding tax rules which can affect international capital budgeting. Import and export rules. import and export rules can affect the policies. Then government policy on borrowing and investing abroad. Policy, you can invest, you can borrow, but then there are certain government regulations which keep changing. As an individual, you can invest $250,000 in a year abroad. As an individual, you can invest $250,000 in a year abroad, and these rules keep changing. Okay, these rules keep changing. Today I am saying $250,000. Tomorrow they may make it $5 lakh, or they may make it $50,000. Okay, all this seriously affect your capital budgeting decision. So how do I incorporate it? I have to visualize. If this happens, if this policy changes, what will be my cash flow? If this policy changes, what will be my cash flow? What is the probability of this policy? What is the probability of this policy? What is my expected value? And if the risk is more, I have to use a higher discount rate also. I have to think about abandonment of the project also. This way we can introduce the impact of change in government policy on capital budgeting decision. So if you are seriously investing in big projects, you have to think from different angles. How the change in technology can impact you, how the change in government policy can impact you. Keeping all these in mind, we will take the decision. Is it right? Hello dear student friends, now we are going to take some MCQs on advanced capital budgeting. I hope all of you are ready. Let us see how much you have studied on advanced capital budgeting. Have you understood or not? As a teacher, we are also interested in knowing whether our students are learning or not. One of the ways just to test quickly whether the students have understood the concept or not is through MCQs. Here is my first MCQ for you. You have to answer A, B, C or D. Okay. So while typing your answer, you have to write 1A, 2A, 2B, whatever, so that I can understand which question you are replying. Otherwise, sometimes the answer comes a little late, and by that time I have moved to the next question. So are you ready? Answer first question. Risk arises from various sources: market risk, competition risk, international risk, all of the above. Which option is right? Very good. You have given correct answer D. Option D is right. Try the second question. Expected cash flows are calculated as, which we have done in this chapter in the beginning. Expected cash flows are calculated as sum of the likely cash flow of the project. Very good, Sajid. Sum of the likely cash flow of the project multiplied by probability of cash flow. Third, sum of the likely cash flow of the project divided by the probability of cash flow. And D, none of the above. Which option is right? 2B. The student is saying 2B. Very good. 2B is the right answer. Third, variance measures A, how far each number in the set is, just write this also if not printed in the book, away from the mean. The second line, away from the mean, is not typed. Please write it in your book if not typed. B, the mean of a given data set. What variance measures? How far each number in the set is away from the mean? The mean of the given data set, return on investment, level of risk borne for every % of expected return. You have to choose the best option. If you think more than one options are possible, choose the best option. So the correct answer is A, 3A, tick mark 3A. Question number 4, certainty equivalent approach is option A, guaranteed return from an investment after adjusting for certainty equivalent coefficient, return that is expected over the lifetime of a project, equivalent to net present value, an important component in decision tree analysis. What is the right answer? 4A, very good. 4A is the right answer. 4A, guaranteed return from an investment after adjusting for certainty equivalent coefficient. So the formula for this is certain cash flow equal to uncertain cash flow into certainty equivalent coefficient. Very good answer. Okay, question number 5 will require calculator. The firm is expecting an NPV of 10,000. If the economy is exceptionally strong with 0.3 probability, NPV of 4,000. If the economy is normal with 0.4 probability, an NPV of 2000. If it is weak, 0.3 probability, what is the expected NPV? Quickly reply. The student is saying 5A. 5A is the right answer. If you multiply all these numbers and take the total, it will come to 5200. So 5200 is the right answer. Now the question number 6 is, what is risk premium? What is risk premium? Risk premium is the extra rate of return expected by the investor as a reward for bearing extra risk, equivalent to the rate of government securities return provided to equity shareholder, or risk-free return or risk-free rate of return. 6A, the student is saying 6A. 6A is the right answer. It is the extra rate of return expected by the investor for taking extra risk. You are right. 7th number, calculation of coefficient of variance depends on. Calculation of coefficient of variance depends on standard deviation, expected return, expected cash flow, all of the above. Coefficient of variation, standard deviation upon return, but this return can be expected cash flow also. So the answer will be all of the above. All of the above. Very good. Next, scenario analysis is considered under scenarios such as worst case scenario, best case scenario, best case scenario, all of the above. Answer is very obvious here. In scenario analysis we consider worst, best case scenario. All of the above is the correct answer. Very good. Question number 9. Sensitivity analysis is useful in decision making because it shows the probability associated with each outcome. Write down. It tells the user how much critical each input is. It allows to calculate the probable result under different scenarios. The results of sensitivity analysis are reliable. What is your answer? After doing sensitivity analysis, you will get to know that sensitivity of the project is 20%, cash flow is 25%, discount rate may be 2%, material cost may be 5%. So after knowing all this, you will get to know the criticality of each input parameter. For example, if the sensitivity analysis gives you 2% only, it means discount rate is very critical. Change in discount rate even by 2% can affect the project. So you will tick mark B. B is the right answer. This is the scenario analysis. This option is for scenario analysis. A and D are totally wrong. Question number 10. When the risk is high, the cash flow under certainty equivalent coefficient will be CEC and cash flow. CEC and cash flow. Tell me, are directly related or inversely related? They are inversely related. Higher CEC means risk is less. CEC and risk is inversely related. But if CEC is low, risk is high. This is inverse relationship. So the answer will be B. If the risk is high, the CEC of the cash flow would be lower. So tick mark B. 10B was the right answer. 10B was the right answer. Okay. So with this wonderful chapter is over. Dear student, we have uploaded all the lectures on YouTube channel also. So in case if you have missed anything, you can watch it again on the YouTube channel. You can also ask your friends also who have shifted from old course to new course and will be writing the exam in May or November exam, that they can watch this advanced capital budgeting lecture on the YouTube channel also. Is it right? So this chapter is over.